Okay, I'm going to get us started. So thank you again for making time for this training. Definitely ask questions as they come up. Shoot any questions through chat if you need to. We're happy to stop and discuss some of these items as needed. We are going to just do kind of a high-level overview of not-for-profit audit and tax. So again, Karen and I have had a chance to introduce ourselves, but in the slide deck, we do have a little bit more information about each of us. A little bit about Clark Newber. So we are a CPA firm that's located in Bellevue, Washington. We actually probably need to update this slide now. We're over 320 employees at this point. We do only have that one physical office in Bellevue, but we do have employees throughout the United States, and we work with clients throughout the United States. We've got over 70 years of experience, and we have one of the larger not-for-profit practices in the country. So we spend a lot of our time helping not-for-profits either through their compliance needs, such as audit or tax work, or also just consulting or helping with bookkeeping, all those types of services. We always like to put this little disclaimer on there. This is meant to be informational in nature, and any kind of decision making you need to do, make sure you're going to a qualified professional advisor. So what are we going to spend time on? The first half of the session, we're going to talk through audited financial statements, what's required, and how to prepare them. We're also going to go over the single audit, so what's required with a single audit and how to prepare. And then for the second half, I'm going to turn it over to Karen to talk through all the tax exempt type items. So the different types of exempt organizations, how you qualify for them, and what you must do and what you can't do. That's always the exciting thing, is talking about just definitely don't do this. Okay, jumping right into the financial statement audit. So why would an organization have an audit? So there are a couple different triggering items that make an audit required versus maybe they might be kind of just a best practice type item. So if you have debt with a banking institution, sometimes they do require you to provide them with audited financial statements, usually within a certain time frame after your year end. So it could be a debt requirement to have an audit. There are also state requirements. So there are different states will have different requirements on when a financial statement audit is required. Washington State has a requirement that if you have in the past 3 years had average of 3 million in revenue and you solicit contributions, then you've got that requirement to have an audit. It's a lot more nuance on that. There's a lot of specifics within that regulations, but as a general concept, if you see your organization having more than 3 million in revenue and you also solicit contributions, definitely start looking at that state requirement to see if you are required to have an audit. Other states have lower requirements. For example, state of California has a $1 million threshold requirement, so each state is going to be different. There could be a federal requirement, and that's also why we're talking about the single audit, because sometimes the single audit will trigger you to also have a financial statement audit, because when you have a single audit, you are required to also have a financial statement audit. So the federal requirement we're going to get into in more detail, but if you expend federal funds over $750,000, you will be required to have a single audit. Effective for years beginning on or after October 1st this year of 2024, that threshold is now increasing to 1 million. Lastly, the ones that we usually see for newer not-for-profits or organizations that don't meet that state requirement is it's usually a board request to have audited financial statements. So as part of the due diligence by the board, they want an independent third party coming in to take a look at your books and see if the treatment is appropriate for your financial statement. So it could either be by policy for the board, it could be a risk management factor where they just want to make sure they're mitigating their risk. They're looking for independent assurance that the books are clean. And one of the things that they sometimes also are looking for is just a thorough look into accounting policies, procedures, and practices. So they want that third party looking at those items. And then sometimes donors also are looking for audited financial statements. They may request to see your audited financial statements before making donations or as part of their consideration to give a donation. So those are all areas that could trigger you needing a financial statement audit. So who uses the financial statements? There are various users of the financial statements, and they can range from organization to organization. Some of these may be applicable for some organizations and not applicable for others. Quite oftentimes, the ones that we see most using financials tend to be donors, the board of directors, and then members within the organization. Those tend to be some of the bigger ones that look at it. However, creditors, rating agencies, and governments can also be users of your financial statements. They may ask to see your audited financial statements. When we talk about financial statement reporting, there's a couple different options that an organization can do. You don't always have to jump to an audit if it's not required. There are other services that you can do. They have different levels of assurance related to them. So compilation is simply the preparing of the financials statements and footnotes, and there's no assurance provided by the CPA that they are materially correct. A review is looking at more inquiries and doing analytical procedures, and that gives limited assurance, but it's not the reasonable assurance you get with an audit. So an audit is that next tier down where you are also, in addition to doing inquiries and analytical procedures, we're also verifying information with outside party. We're examining source documents, so we're looking at donor letters, we're looking at bank statements, so we're doing more looking at those documents that are supporting your numbers. An audit also does a review of internal controls. We gain an understanding of your internal controls and how they impact the financial statements. And then what we do is we give reasonable assurance that those financial statements are materially correct. So when you have a financial statement audit, the purpose of an audit is for the independent auditor to issue an opinion that accompanies your financial statements. And that opinion is giving assurance to the users that the financial statements are materially correct. So the information within the financial statements are materially correct. So what it doesn't do is it doesn't give absolute assurance. We do look at materiality. And so we're not necessarily going to be testing 100% of the transactions that an organization has. We are looking at kind of whether or not the financial statements as a whole are material. So as part of that process, we have kind of a step process to go through the financial statement audit. So the first thing we do is we do our planning, where we gain an understanding of what's been going on with the organization, if there's been any major changes. We also gain an understanding of internal controls. And then after we have that information, we do our risk assessment. So we evaluate your internal controls. We do some brainstorming to see kind of what areas do we think have a higher risk in your financial statements. And that risk can be based on things like it is a very large balance. That's going to increase risk for an area, or there's a significant volume of transactions going through that balance. So if there's a lot of transactions going through it, we may spend more time there. We'll also develop what we determine as materiality. So we'll look at your financial statements as a whole, and we'll determine what would be material to those financial statements. And based on that materiality, that helps scope what areas we're going to focus in on. And then from that, we develop an audit plan. Once we have our audit plan, we go into the testing procedures where we will do some testing of internal controls. We may just do walkthroughs to see that the controls are in place, or we may actually do testing of controls. Testing controls is not required for a financial statement audit, but it is one of the ways that we can approach our testing plan if we want to. We'll test financial statement balances and disclosures. So I'm going to walk through the components of the financial statements in a couple slides where we can talk through things as an auditor that I would be looking for. And then we do some fraud procedures, but we always like to highlight the fact that if you ever look at studies done over fraud, the #1 detector for fraud is actually somebody within the organization, a whistleblower type notification of the fraud, not the audit. Because the purpose of the audit is not to discover fraud. That's not our purpose. But we do incorporate some fraud procedures in our steps. We then complete all of our testing steps, and then as part of our audit, we are required to communicate certain items to those charged with governance. So we usually meet with the board or the finance committee and discuss the results of the audit as part of our closeout process. Before I get into the required financial statement components, any questions so far about the audit process? Okay. So when we step into looking at the required financial statement components, when you look at what's required under generally accepted accounting principles, so that's US GAAP, there are certain areas that are required in your financial statements, and there are areas that give a lot of flexibility for not-for-profits on how they present different things. So we're going to go through that. Again, what we are giving an opinion on for an audit is that your financial statements materially comply with US GAAP. So that's really what we're looking for in your financial statements. So when we look at the different financial statements, statement of activities, that is what is commonly known as maybe your income statement. So if you don't have a not-for-profit background, this is what your income statement is. For not-for-profits, it's a statement of activities, maybe statement of activities and changes in net assets. Sometimes they include that language as well. But it basically breaks down what is your revenue and what is your expenses. So if we go through the required elements to your statement of activities, it's pretty straightforward. You are required to have a change in net assets with donor restrictions, and you are required to have the same change in net assets without donor restrictions. So if we go back to this table, this is an example where this organization has set up their revenue to be in what's called column format. So you've got your without donor restrictions in one column, and then your with donor restrictions in another column. And then at the very bottom, the third line up from the bottom, you've got your total change in net assets, and it's got the both with and without donor restrictions. You can have the stacked option where you show all of your without donor restrictions on top, and then do with donor restrictions secondary, or you can do this column format. So you kind of can do it in a bunch of different ways. And then you also need to have your total change in net assets. So that's this very far column over. You've got your total for the year, total change in net assets. Otherwise, you have some flexibility in how you present these financial statements. And so from an audited perspective, we are looking at to make sure that you've got the required elements. And then we're going to be testing these balances to make sure they're showing up in the right column. So we're going to be testing your revenue to see that there really is 400,000 in restricted revenue. Or we're going to be looking at how you're releasing those restrictions and testing those. Same thing without donor restrictions. We're going to be testing these numbers that you're listing here and tying out to supporting documentation. So other things that you can consider, again, we talked about how GAAP allows that flexibility in how you present it. One of the other things that you can do is you can have an intermediate measure of operations or other similar subtotal. So that is the concept of, on this picture, you've got net operating activities, and then you've got these non-operating activities. So again, not required to break out, but a lot of organizations find that it's helpful to break out things like investment return and maybe endowment information from their operations. So when they're talking with donors or they're talking with the board, they can really focus in on this operations number and not so much on a number maybe that they don't have as much control over, like an investment return. So that is an option that you can do. If you are a healthcare entity and a not-for-profit, you're actually required to show this operating measure. So next, moving on to the statement of functional expenses. So here's an example of a statement of functional expenses. So for this organization, they have chosen to do it as a statement. One of the items to note is you can do it as a statement, as a note in your footnotes, or within your actual statement of activities. So instead of having expenses here that say program services, management in general, and fundraising, they would have it broken out between the natural class and their allocation to the program management in general, right on the face. That gets a little messy, so we usually see most organizations go this route or go into a footnote. So this is the required concept of when you have your expenses as a not-for-profit organization, you're required to allocate those expenses based on what function they're serving. So you could have expenses that are only programmatic in nature, and so they show up in that program services column. You could have expenses that are only management in general, and so they show up in that management in general function or fundraising. Or you could have a cost that benefits all of them. And so then you have to come up with an allocation of how you're going to allocate it. So a great example of this is maybe rent. So if you're renting a space and that space both houses your programs, it houses your admin, and it houses your development group, then you need to figure out an allocation for that rent expense to how that cost should be allocated to the different functions. So what this is essentially doing is it disaggregates your functional expenses into their natural classification. So you can see in this schedule, the natural classification shows up in the rows, and then the columns are those functional items. So one of the things to note is that your statement of functional expense must include all expenses except for any investment expense that's netted with investment returns. So that's usually your investment fees, gets netted with your investment returns. And any other expenditures that are considered more losses. So they're included in gains and losses instead. So in this example, you can see that they have a row that says total expenses from operations, and then they add in the costs of doing special events, and then that gets them to their total expenses. But that cost of the special events is actually netted with revenues on the statement of activities. So what gets pulled to the statement of activities is just that total expenses from operations instead of the total functional expenses. So you can see how if you have any costs that are showing up with your special events, it says net of expenses of a certain amount. You don't include them then in your expenses on the statement of activities because you're already pulling them out of the related revenue line item. But on your statement of functional expenses, you have to show it there. So it becomes this little weird reconciling item at the bottom. One of the things we look at from an audit perspective for this statement specifically is how are you doing your allocations of those costs to the different functions, and do they make sense, and are they consistent with previous years? So making sure that you're not showing all of your costs in program when you actually have costs that are management in general and fundraising. Okay, statement of financial position. So the statement of financial position is a not-for-profit balance sheet. So this is where you're going to be showing all of your assets and your liabilities. And then not-for-profits don't have equity. Instead, they have what's called net assets. And those net assets are broken out between what is with donor restriction and without donor restriction. So within your statement of financial position, you also have a lot of flexibility in how you present it. So there's only a handful of really required elements. So you're required to show total assets, and you are required to show total liabilities. And then you need to show net assets with donor restrictions and without donor restrictions. So you need to have both of those components. Other things you can do is you can do a classified or an unclassified balance sheet. So a classified balance sheet is when you're showing what is current assets and current liabilities versus total assets and total liabilities, or those long-term assets, long-term liabilities. So that's how this one is presented. It's breaking it up by what's current versus long-term in each of those. Not a required element. If you're going to do an unclassified, generally what organizations do is they list their assets and liabilities in the order of kind of liquidity. So like, even if you're not showing it as a current asset, you would always have cash up front. There could also be effects of donor restrictions or other restrictions or self-imposed limits like board designated type items that you may want to present on your statement of financial position as well. So if you have cash that is restricted by debt, then you might break that out separately as a separate line item. Or if you, within your without donor restrictions, you have those board designated items, you can break those out on the face of this financial statement, or you can disclose those in the footnotes. So when we're looking at an audit, if you've got your statement of financial position here, and you're thinking about, okay, as auditors, we're looking at your material kind of balances. We're going to be looking at certain items to test. We're always looking at your cash. Investments look like they're material for this organization. Accounts receivable is material. So those large balances, we're probably going to spend a lot more time testing. And what we do is we get the underlying detail behind it, either reconciliations or third party support, what's going into those numbers. And that's what we're testing to see that the numbers are materially correct.
So Kelly, for for if you're just starting out as a nonprofit, I know you went over some minimum requirements, but like this example was a nonprofit that's probably doing really well. So do you have any suggestions for the newer nonprofits so they're not like, oh my gosh, and they probably don't have a strong, robust financial system as well? Any thoughts for them?
Yeah, so for kind of those new not-for-profits, the key thing is these financial statements look great, and they clearly have a long history, especially when you're looking at the without donor restriction number. But in general, your financial statements as a newer not-for-profit, you just need to know what those numbers are. And one of the things that we really look at um, for all organizations is if you see that you don't have enough assets to cover your liabilities, that's when you need to start looking at what other things should you be doing from a cost cutting perspective or anything like that. So you want to make sure that your assets can cover any outstanding liabilities you have. And even if you look at this organization, if you compare their current assets to their current liabilities, they do have a cushion there, but they may have, almost 5 million in assets, but they also have 4.3 million in current liabilities. So watching those two and how they interact with each other is huge. Also making sure that you have a healthy amount of without donor restrictions. So if you are doing fundraising, really working with your donors to show them your numbers as to why you really do need some of that unrestricted donations to help support your organization. Because once you get too heavy with your donor restrictions, it's really hard from an operational standpoint to just do the things you need to do as an organization if you don't have somebody giving you those unrestricted contributions. So really having the financial information to show that is helpful, because you can say, we have net assets of 200,000, but if 190 of that is restricted, it doesn't give the organization enough flexibility to just operate its back end overhead type services that are needed for an organization to run. Great question. So then when we're looking at footnotes, quite oftentimes your footnotes are ones, especially for a new organization that's having an audit for the first time. A lot of times your auditors will come with example footnotes, and then you're just kind of building out your story within those. So part of the footnotes that we look at is we look at what's the summary of your accounting policies. So when you're looking at your statement of financial position, any of these material balances, we would expect to see a corresponding footnote that explains how these amounts were determined or what they're comprised of. And so that is how your footnotes then relate back to your financial statements. Basically, takes this information and then gives more detail within your footnotes as to what's included in all of these items and how do you record the different items. Other required components are if you have any concentrations. So let's say of your revenue, 50% comes from one donor. That would have to be disclosed because it is a risk to the organization. If that donor were ever to decide not to donate, that becomes a risk to the organization. You also disclose any commitments you have, any related parties. So for a financial statement consideration, those are related parties such as board members who are executives on companies that then maybe make donations or do some sort of work for the organization. That would be a related party. One of the other newer disclosures in the past few years, although it's probably been 5 or so years now, is the liquidity and availability disclosure. So that's the concept of if I look at my assets, what of those assets are actual financial assets to me? So cash and investments. And then of those, what do I have commitments kind of outstanding? So, maybe you've got an endowment out there. So you've got endowment investments and you want to pull that back out because it's not available for next year's operations. So that's where we're talking about this liquidity disclosure is of your financial assets that you have, how much do you have available for future expenses? That's another area where if we see that disclosure start to go kind of negative and you don't have financial assets for next year's expenditures, we would then start going into this concern about the organization's ability to continue as a going concern. So a red flag for us is, you have very low unrestricted net assets. You have multiple losses for multiple years. And then this liquidity disclosure is showing that you really don't have a whole lot of financial assets to support expenditures in future years. If that is the case, one of the things that we have to include in our audit opinion is if there is any concern about the organization's ability to continue as a going concern. So your financial statements and the way that you present them is assuming that an organization is a going concern, which means the organization is going to be able to continue at least 1 year from the date of the auditor's report. So if we have any concerns about the organization not being able to meet that kind of threshold, we then have to have management go through and see if they think that they also have a substantial doubt about being able to continue as a going concern. And then we have to disclose all of that information. So after the pandemic, a lot of not-for-profits got a lot of federal funding from COVID, and that funding necessarily wasn't replaced now. So that funding kind of ended. We're seeing a lot of not-for-profits struggle in this area and have liquidity issues. So this is something that we always look at as part of our audit as well. Other things within the footnotes that we look at subsequent events and any like contingencies that need to be disclosed. So knowing what we're looking at from a financial statement audit and the numbers that we're basically giving an opinion on, what can you do to really prepare for your financial statement audit? So when you think about your financial statement audit, your audit is not there to find where you've made errors. It's really there to make sure that you have been doing things right throughout the year. So one of the ways you can do that is really by reconciling all of your accounts. So that includes reconciliation of all your asset accounts. So if you've got a GL account for other AR, you should have some sort of reconciliation that shows what is included in that GL account. Same thing with all your liability accounts. You want to have those reconciliations. Generally, you want to try to be doing those reconciliations monthly. Depending on the level of activity in different accounts, you may decide, well, we're only going to reconcile this quarterly, or we're going to reconcile it once a year, just because of the level of activity. If it is cash, you should be reconciling that every single month. There's just a lot of activity that goes into your cash accounts. You need to be reconciling that every month. If you have any sub ledgers that feed into then your overall ledgers, you want to make sure that there's some sort of reconciliation process there. And then the number one issue that I run into on not-for-profits is the donor database being separate from finance. So it's being done by development. And that database not being then reconciled to the general ledger, because development may track different items that don't qualify to be recognized as revenue yet on your financial statements, but it's important to know what is out there that could potentially be coming in. So having that reconciliation between what development is tracking versus what finance has is really, really important. Another thing that's important is looking at your year-end close. So making sure you have a checklist of what needs to be booked to make sure you have any proper accruals booked. So if you're operating on kind of the cash basis throughout the year, that's fine, but make sure at year end you're doing this reconciliation to make sure that you've got all the proper accruals. Do you have any pledges receivable accrued? Do you have your payroll liability accrued? All of those items need to be there before the auditors come out. The other thing you should be looking at is reviewing the transactions at year end and then the following month at least. You may decide to do 2 months after year end, depending on the type of transactions you have, just to make sure you have the proper cutoff. So all the contributions are getting recorded in the right year. All of your liabilities are getting recorded in the right year. So that year-end close is really important. Looking at your internal controls as well, making sure you have it documented what your controls are. Quite oftentimes what I see for not-for-profits that are new is they will document maybe a process, or the person that is working there just knows what the process is and doesn't document it. So having that documentation is really important. For small not-for-profits, we oftentimes see that you can't segregate duties as much. So maybe one person is doing, the receipt, the booking, and the payments. They're doing all of it. So when you have those instances, look for ways that you can implement detective controls, because you're not going to be able to have preventative controls. So those preventative controls are by segregating duties of who's doing what. And in small organizations, you really can't achieve that. So look for ways where you can have more detective controls. So like who's doing the review, how detailed is the review, do you have your board kind of looking at a budget to actual, and stuff like that, where maybe the bank statements go to the CEO so that they can see what activity is going through cash. So look for those mitigating detective controls. And then it's very important to document. I would say the biggest thing that comes up from an audit is not having documentation as to why a number got booked or a decision got made on how to treat a certain transaction. So making sure you have that documentation and retain that documentation as well. Any question on the financial statement audit? Okay. I'll continue on to the single audit, but I'll probably take a pretty high level on this so that Karen can get to some of the tax items. We wanted to make sure to cover some of the single audit just because we know a lot of not-for-profits are starting to get into federal funding, and it can be very confusing as to what the requirements are. So I wanted to go over high level what we look at for a single audit. Essentially what we're doing in a single audit is we are issuing an opinion on whether or not a program that you are doing complies with uniform guidance, which is the 2 CFR Part 200. And when you look at 2 CFR Part 200, they have a bunch of different areas that we're looking at. We're mostly testing your compliance with the requirements under subchapter D. And then the cost principles, are you charging costs to allowable costs? That's subchapter E. But the audit requirements for those programs are in subchapter F. So who would it apply to? So any organization, a not-for-profit, state and local government, higher institutes, institutes of higher education, and then any subrecipients that could be a not-for-profit, potentially a commercial, may have to follow uniform guidance. Not all of those organizations necessarily have a requirement to have a single audit. But your state and local governments, institutes of higher education, and not-for-profit organizations do. And then some commercial organizations may have to have a single audit if they get DHHS funding. So who needs a single audit? So if you get a grant that it comes originally from a federal agency, so maybe the federal agency has an agreement with the city of Tacoma, and then the city of Tacoma then gives you a grant. If it originated at the federal level, that's considered a federal award, even though your agreement is with city of Tacoma. So if you expend over 750,000 in federal awards during your fiscal year, you then are subject to a single audit. If you only have one federal award, you could have a program specific audit, which is a little bit more simple. But you do have to have, if you have a single audit, you have to have a financial statement audit with it. So both of those must be conducted annually. So what could be a federal award? There's a whole list. I've included the reference in 2 CFR 200 so you can read about it. But most of the time what we see with smaller not-for-profits is they're getting a grant. So they're getting some sort of grant that they now have these federal requirements under. Things that are excluded is if you're getting Medicare, Medicaid payments for patient care. So that's specific patient care. Or if within your agreement, you are listed as a contractor or beneficiary, that would not be included in this. So always look at your agreement to see if you're considered a subrecipient or a recipient. I'm not going to go over too much on this. Most of the funds we see are with those grants. Most of those grants are cost reimbursement basis. So you have to expense items first and then get reimbursed. And the funds are considered expended when you actually have the transaction for the expense. So what is a single audit doing? We issue 2 reports. One is related to your compliance over the major program we've selected. So we may select one grant, we may select multiple grants if they're under the same program. And then we test to see that you are complying with all of the federal requirements under that program. One thing we also do is we also have to test controls as part of that audit. So we're required to perform tests of controls. And then as a byproduct, we would issue any findings over internal controls for your compliance. This is the process. The items in green are the items that in general, the not-for-profit is responsible for. So the items in blue are going to be conducted by your auditors versus the items in green. So I'm going to go over each of these items, but I'm going to skip the first two. So you're required to determine if you have federal awards and you're required to select your auditors. I'm going to go into the preparing for the expenditures of federal awards. So like the financial statements, your schedule of expenditures of federal awards is like another financial statement. So there are certain requirements that you have to have. I'm more of a visual person, so I like kind of looking at one as an example. So when you look at this, you're required to really highlight what federal grantor funds are coming through, if they're being passed through from another organization, what organization they're coming through, and then what the program title is. And this is not going to be the title that your grant it has in it. It's going to be the program title at the federal level. And you can tell if you're getting federal funding because your grant is supposed to have what's called an assistance listing number in it. It used to be called a CFDA number. They changed that naming convention. So now it's an assistance listing number. And the name of the program, if you go to sam.gov, you can search up this assistance listing number and it'll tell you what the federal agency has called this program. So then you're required to make sure you have subtotals for each assistance listing. So you can have multiple grants that have the same assistance listing number and you group all of those into one program. You're required to do totals for each federal grantor. You're required to show any funds that you then pass through to other subrecipients. And then if you receive those pass-through funds from like City of Tacoma, you're required to note that. Again, major program determination is determined by the auditor. They take a risk-based approach. You can read in the guidance specifically what we have to consider. It is almost like an open book test to figure out how we're selecting our major programs. The thing that auditees can do to help with a single audit is making sure that you're providing the auditor with access to personnel, to accounts, books and records, supporting documentation, and anything else needed. And basically what we do, similar to a financial statement audit, we start with understanding what's been going on in the program, understanding what the rules and regulations are. We get detail on what has been happening in that program. So GL detail, if you've got eligible beneficiaries you're serving, we get the population of those. We get access to any reports you've submitted. And then we do a sample usually on that activity and we test those samples. So we're going to be testing to see that you've got documentation in place for all of the required elements under uniform guidance. So how do you prepare for a successful single audit? You definitely want to make sure you have a summary sheet for each award. So if you're starting to get into federal funding, this is one of the biggest things that I can recommend is that you have a top sheet that you include with all of your federal award documents that just summarizes the pertinent information in that award. So everyone knows what's going on in that award. The second item I always recommend is that you set up your accounting software so you can track revenues and expenses on each award. So either setting it up as a separate GL coding or setting it up as a sub GL or a sub designation, something where you can then just track all the revenues and expenses for each award. So if you wanted to, you could have the system spit out a P&L for that specific award. So that's huge. The other thing, as I mentioned, is on a single audit, we are required to test your controls over compliance. So making sure you have it documented what controls you did, and you need to be documenting it throughout the year. We do a sample approach, so making sure that you have all the documentation gathered early. Sample sizes can vary, but you're generally going to see sample sizes between 25 and 60 that are testing maybe a certain type of compliance area like allowable costs. And then you want to make sure that you have all relevant policies. So when you get into federal funding, there are certain transactions that are only allowable if you have written policies. And then there's specific policies that you are required to have, like procurement and subrecipient monitoring. So making sure you have those policies in place if you're getting into federal funding. Again, other things, making sure you're retaining any documentation throughout the year, especially on anything that is a judgment, making sure you're retaining that documentation on how you determined a cost was reasonable or allocable to that award. There are many steps when you have a single audit. So when you're working with your auditors, there will be a lot of back and forth and a lot of steps. So just being aware of that. As with any audit, we really hope that you would reach out to your auditors throughout the year to make sure you are answering any questions throughout the year. And then uniform guidance, there's a lot of training around uniform guidance. We put on a lot of training for uniform guidance. So if this is an area that you are expanding into, please know that there are resources out there that can help you and can help you even with the development of policies and procedures and internal controls. There are resources. We do a lot of consulting in this area, so if you are looking for resources, definitely poke around our website for webinars we do and other resources we have. Other resources you have outside of maybe a CPA firm is you've got uniform guidance, which you can read through and understand the requirements. Additionally, every year, the Office of Management and Budget releases what's called the compliance supplement, which is basically the guide for auditors on how we conduct our single audit. So again, you can get that, search for your program within the compliance supplement, and it'll tell you exactly what your auditors are going to be looking for. So it really is kind of more of an open book test when it comes to what we are looking at, and there shouldn't be surprises, hopefully. And then sam.gov provides a lot more information on the different federal programs. When it comes to reporting, what the auditor is doing is we're giving an opinion on your financial statements because you have to have financial statements as part of the single audit. We're also giving a report on internal controls over financial reporting and compliance with laws and regulation. And then we're giving a report on each major program and a report on the internal controls over compliance. There is a schedule of findings and question costs. So if we have any findings, we draft that schedule of findings and question costs. And then as part of your single audit, you are required to submit that to the government. And we help with that certification process through the data collection form. What's required from an auditee standpoint is you are required to, your responsibility is the financial statements and your schedule of expenditures of federal awards. If you had any prior auditor findings, you're required to do a summary schedule on those findings. If you have any current year findings, you're required to do a corrective action plan. And then you also have to submit and certify the data collection form. So when we look at the schedule of findings and question costs, what's going to show up there? It's going to list what our audit opinions are, if we had any deficiencies, if we had any findings, what major programs we audited, and the last two items I'm not going to get into too much detail about for this session, but there are other required elements we have to disclose as part of that single audit. So here's just some information about what do you do if you have a finding, or what is a finding. So these are the required things. Again, you can read it in uniform guidance. When are your auditors going to be issuing a finding? Really, if we have any deficiencies in internal controls, we're going to have a finding. If you have question costs or even projected question costs of greater than 25,000, we'd have a finding that we'd have to report. Fraud, those type of items we do have to report. We have to include a whole list of things when we do a finding. We have to talk about what the criteria is that should have been met versus what did we see. We have to talk about the effects. So it's a whole required write-up that we do when we have a finding. And then as an organization, what do you need to do if you have a finding? I would say this is also kind of very similar to what you would do if you have a financial statement finding. The first thing that you want to do is discuss the facts and any mitigating circumstances with your auditor. Make sure you and your auditor are on the same page and that you have the same understanding. Then you'll need to review the written finding that the auditor has given, prepare your response and how you're going to do a corrective action plan. If you have a finding in the single audit, you may have to repay some of those costs that you had. If you have question costs, it can affect how much testing is done in future years for your audit. It can impact how your funder does a risk assessment for you. And it may have federal agencies impose more restrictive reporting requirements. So if you previously just had to submit an invoice, they may start asking for the backup behind that invoice if you have findings. Again, the corrective action plan that you would be doing, you need to reference the auditor's assigned reference numbers for that finding. You need to note the names of the contact person who is responsible for the corrective action plan. You need to describe the corrective action plan and then the anticipated completion date. Now, if you don't believe or don't agree with the finding that you have, you can provide an explanation as to why. However, I will say that most federal agencies push pretty hard on that because they kind of default to the auditor called that out as a finding for a reason. So disagreeing with the auditors can have some risk. If you had prior audit findings, there are certain requirements that you have to do as the auditee. You need to know if the finding was corrected and when it was complete. If it was not corrected, you need to kind of note why. And that's it for the single audit. Any questions on the single audit before I turn it over to Karen? Okay.
Okay, everything was pretty clear. Kelly, do you want to continue with the slides? And
Yep.
Okay. Well, we're going to talk about tax exemption. Next slide. Okay, so what I'm going to do here is I'm going to talk about, I'm not going to go through the Form 990 or the filing requirements, well, maybe a little bit, but basically, I think if you understand what you need to do to maintain your tax exemption, what you can do, but don't have to do, what you can do, but only to a limited extent, and then what's completely prohibited. And hopefully I'll be able to tell you where this all comes from as well, so that you, when you're faced with something, let's say a decision to go into an activity, maybe an unrelated business activity, maybe lobbying, maybe who knows, you'll know the questions to ask your tax professional. Next slide. Okay. So frequently, people, organizations are not understanding some of these concepts. So I'll get very basic here. Not-for-profit is a state concept. Organizations are organized by state. Usually they're incorporated. Sometimes they're trusts, sometimes they're associations. It's a state law concept. So there are not-for-profit organizations that pay taxes. They are not tax exempt. Tax exemption is a federal law concept. In order to be tax exempt, you have to be providing a service that maybe otherwise the government would have to provide, and therefore you deserve to get some tax exemption. Now, there is a tax exempt concept in state law. It's usually state property taxes. Sometimes they have state income tax exemptions, sales tax, and that sort of thing. Washington State has no blanket exemption. If you look at the Washington State exemptions from, let's say, B&O tax, for example, or property tax, they're very, very specific. It kind of depends, I guess, on the lobbyists that arranged for that. So when it comes to state exemptions, you really need to speak to a state and local tax expert, which we Clark Newber has a very, very good tax exempt state and local tax team that can help you with that if you need it. Next slide. And my throat's getting dry too. Okay, this is part of why I love tax exemption. It is very old. It's been around since biblical times. The king actually gave David and his family tax exemption for killing Goliath. That's how old it is. That's older than that, apparently, as well. So anyway, if you can check the site if you don't believe me, but yeah. And also fun is taxes have been around for ages as well. I went to a museum and I found a clay tablet tax return. So from ancient times. So tax can be fun. Okay, now 501c3, you hear a lot, I'm going to get my C3, I'm going to get my C3 status and, all that. There are so many different kinds of C3s. There are actually so many different kinds of exempt organizations, but we're going to deal here with C3s. Basically, they provide a public benefit. They're charitable, religious, educational, scientific, testing for public safety, literary, amateur sports, and prevention of cruelty to children and animals. Next slide. Now, under C3, this is another common misconception. There are different kinds of C3s beyond that. There are C3s that are private foundations. There are C3s that are public charities, variety of different kinds of public charities. All C3s are presumed to be private foundations unless they meet a public charity rule. Next slide. So public charities, they're public, okay. And what they mean by that is one is they're statutorily public, like a school or a hospital, some research organizations, that sort of thing. Or they meet a public support test, which is basically a math test I'm not going to bore you with. Or actually, it's on the slide, so I will bore you with it. Also churches, don't forget churches. Churches are public by nature. Churches, by the way, also don't have to file tax returns. Churches also don't have to file an application for exemption. Publicly supported, the math test, there are two different tests. One is we call the 1/3 test. So 1/3 or more of support has to be from public sources, and that includes government. The second test is what we call what I call the 1/3, 1/3 test. More than 1/3 has to be from public support, and less than 1/3 has to be investment income. So what you see mostly is the organizations that meet the 1/3 test, the 509A1 test, are organizations that receive a lot of government grants. They receive a lot of public contributions. The 2-part test are organizations typically that will receive a lot of fees for service. Okay, then you have supporting organizations, which basically ride the coattails of the publicly supported organization. They're not publicly supported themselves. And testing for public safety. Next slide. Okay. Now, the reason this makes a difference is because as a public charity, there are certain benefits that private foundations don't have. There are certain restrictions that private foundations are subject to that public charities are not. So, for example, private foundations will pay excise taxes at I think it's 1.39% on net investment income. Private foundations will have minimum distribution requirements. Public charities do not. There is no excess business holding restriction with public charities like there is for private foundations. The public charities may make grants to individuals or non-charitable organizations, provided it furthers their exempt purpose. They may receive grants from private foundations, and they may do some lobbying. That's part of the can do, but to a limited extent. And then they also have less restrictive contribution deduction limitations. Okay, next. But with all that, the private foundations, even though they do have a lot more restrictions and their penalties are very severe if they run afoul of some of those, there are some benefits, and why some are, as you know, there are many organizations that are private foundations, and the reason is they have more control over their investment of their assets and how they spend their money. And they don't need to fundraise. They usually are supported by a single source, family, perhaps, Gates Foundation, Ford Foundation, you've heard of them. Next. There is an in-between, private operating foundations, and they're sort of in between the private foundations and the public charities. And they get some benefits because even though they might be privately funded, they meet certain math tests of how they spend their assets, but they're operating, like a museum, for example, that might be privately funded, might be a private operating foundation. And there are some advantages, such as they're not subject to the distribution requirements. They may receive grant from private foundations. Private foundations cannot receive grants from other private foundations without jumping through some hoops. Next slide. Okay. Now to the nitty-gritty. To maintain a 501c3, and here's where I kind of want to get in on the ground floor. I think a couple of you were Chatone, I think you said you were a new organization. I don't enjoy when organizations come to me years later and they have done prohibited activities, or they've excess limited on their limited activities, because then it's almost too late. So it's best to know what you can and can't do, or at least the questions to ask your accountant, CPA, your lawyer, before you enter into some of these. So there's been a lot of talk about political campaign activities, for example. Those are completely prohibited by 501c3 organizations, completely. You can lose your exemption. Private inurement, and I'll explain what that is in a bit, but that's completely prohibited as well. Unrelated business activities, you can do that to a limited extent. Substantial unrelated business activities are prohibited as well. You can lose your exemption, and substantial lobbying. So those are in the limited category. You can do limited lobbying, limited unrelated business activities. Private benefit is something that can be done to a limited extent. And what you must do, of course, is to file your Form 990 every year, 990N, 990EZ, 990. Failure to file that return for 3 or more years, you're automatically revoked. and there's nothing that can be done. You could call the IRS till you're blue in the face and say it was a mistake and there's nothing to be done except apply again. So you have to go through the entire thing all over again. Now, you also must be organized and operated for exempt purposes. And this is, where, as we looked at the exempt purposes, education, religious, charitable, it has to serve a public benefit. I mean, that's why David got his exemption. He killed Goliath. It was deemed to be to the benefit of the community. So, next slide, I think. Yeah, so getting into that, when you're talking about public benefit, it has to be both in the organizational documents and you have to also be operated. I'm presuming you all have your organizational documents again. Just keep this in mind also if you're making any amendments. Most important is the purpose clause and then the dissolution clause. The assets must be dedicated to exempt purposes. For the operational test, the code actually says the organization must engage exclusively in exempt activities. That has been defined as primarily, and that's why you're kind of allowed to engage in some activities to that limited extent, such as lobbying, unrelated business activities, incidental private benefit. And again, the prohibited activities of political campaign activity and private inurement. Next. So often also not understood is the difference between private benefit and private inurement. That's often sometimes not understood even by tax professionals. Private benefit is benefiting the general public. In order to be tax exempt, you must benefit a broad segment of the general public. There must be a large, broad charitable class. So you can't just say, okay, well, we're going to benefit, let's say the graduates of 1999 of this particular school. That's not a large enough class. So that organization would not qualify for exemption. And if it was somehow got exemption, it would lose it pretty quickly. However, you'd ask that since you have to benefit the general public, is that private benefit? That's considered incidental to serving your purpose, your charitable purpose. And if you're serving your charitable class, then that's not a prohibited private benefit. Private benefit would be like, operating. If I start a charity for all the people with the last name of Dunn, that would not exactly be a charitable class, wouldn't be broad enough. So that would be considered private benefit. You can't set up a charity to pay the hospital bills of one or two people that were in a car accident, for example. That would be private benefit. So think about the charitable class, just must be broad. Private inurement is different in that the person you're benefiting here would be a person inside the organization. So it is a private benefit, but it is a person inside the organization. So that comes from the code, which says you may not distribute your revenue and assets to benefit any private individuals. But what we're really talking about is a person that has influence on the organization. So you're talking board members, officers, founders, those kinds of people. So this could occur if you engage in a transaction. Let's say you want to rent space from one of your board members. You want to buy your copy machines or computers from one of your board members. They may be giving you a very good deal, and that's okay. So you'd have to follow your conflict of interest policy. You'd have to jump through a few hoops to show that this was reasonable transaction. You'd have to, the board would have to approve it. They'd have to look at other organizations and make sure that this is a good deal and best for the organization and that they're not paying any excess consideration for, let's say, the deal. There is a pretty miserable excess benefits tax, very onerous. if, let's say, you're overpaying a private individual, it can come out in compensation as well if you overpay compensation to an officer, let's say. The first years and years ago, the remedy that the IRS would have would be revocation, complete revocation, if this occurred, even to a small extent. And that wasn't necessarily fair to organizations that kind of fell into this by accident. They were well-meaning. So in lieu of revocation, they came out with this excess benefits tax, which was kind of modeled after the private foundation self-dealing rules, which I won't get into, which are even more onerous than these. But I think the next slide might actually have the excess benefit tax on it. Next slide. No. Okay. Well, yeah, it does. Okay. So the excess benefit, I just wanted to put that on there just to show you how onerous it is if you do overpay a person on some kind of transaction, whether it's compensation or purchase of some services or something. The initial tax is 25% of the excess benefit, but take a look at that. It's on the disqualified person. It's on the person of influence. And then look, an additional tax, 10% on management. It's on who made the decision. So you're kind of out of your own pocket, and the organization cannot pay that for you. There's additional 200% if it's not corrected within the taxable period, and that's on the disqualified person. So it's very important to not only not engage in those things to begin with, but if you accidentally fall into it, undo it. Disqualified person, I kind of defined it a little bit. They're a person of substantial influence. There is a 5-year look back rule. So we're talking even former board members, family of that person of influence, companies that they own, 35%, donor or donor advisors to a donor advised fund, an investment advisor of a sponsoring organization of a donor advised fund. So it kind of extends a little bit beyond just who's on the board or who's within the organization. Look at family, look at companies they own. Next slide. Okay, the one way you can do it, like I said, is to make sure it's reasonable. Public charities have another advantage over private foundations. They have what's known as the rebuttable presumption of reasonableness. What this does is if the public charity jumps through a certain amount of hoops, if they follow certain steps and they document them, if the IRS comes in and says, wait a minute, you're overcompensating your officers here, you owe excess benefit tax, or we want to revoke you. If the organization can show that it engaged in these steps to determine this compensation, then the burden of proof, instead of the organization's burden of proving that it's reasonable, the burden of proof shifts to the IRS to prove that it's unreasonable. And that's not so easy to do, honestly, unless it's an egregious situation. So here are the steps. I've actually when you look at it online, you'll see 3 steps. I've broken up 1 step into 2 because it's often forgotten. It has to be approved by an independent board or committee. So that's people not involved, not related to the person that's engaging in the transaction. We call them a disqualified person for shorthand. So not so not related to that person. There's none of this also wink wink, I'll set your compensation if you set my compensation, those kinds of relationships. So they have to be truly independent. The agreement has to be done in advance of the arrangement, and that almost sounds like a no-brainer, but I can't tell you how many times organizations come to me after they've already done this and they want to backdate an agreement. Not going to work. The organization has to use appropriate comparability data. And that would be, depending on what the transaction is, I bring up compensation because I do a lot of compensation studies, but it could be any kind of transaction. If it's rental of real estate, if it's purchase of real estate, you would look at those kinds of things. With compensation, you're going to look at compensation surveys. You might want to get an appraisal if it is property for sale, for example. So depending on the circumstances, the data will be from some other, different sources. Then it must be documented, and this also has to be written. Board minutes are okay, but it has to have certain factors in it. So it would have to be the terms of the agreement, the date, who approved it, who voted for it, and who didn't vote for it. Anything about the debate and what data was used, and copies of the comparability data, copies of the agreement. It has to be concurrent, which has been defined to mean by the next board meeting or within 60 days. And, in tax law, I always say it's been defined to be, because lay language doesn't always match the IRS definition of, of certain terms. So in here, concurrent means by the next board meeting or within 60 days. Next slide. Okay, lobbying activities again. Okay, so long as it's insubstantial, and that's for public charities only. And this is also, organizations typically misunderstand what lobbying is. Educational activities is not really lobbying. Lobbying is a communication to legislators or to your grassroots population for them to influence, to write to their congressperson, influence legislation. It has to do with specific legislation, not just educating. Often when we do the tax return, it's all lumped together and it's not a very large number, so it doesn't matter. More of a burden to break it out than to actually just report the whole thing as lobbying. But if you could separate out the real lobbying from your educational purposes, that would be good. Political activity is completely prohibited. That's participation in a campaign for office. Statements for or against. Now here the key is it is for someone running for office. So, so typically what happens in these kinds of things is an organization that really wants to do more lobbying than perhaps they are thinking they should, or are worried about being allowed to. They will set up as another organization. And we often see groups of organizations, a 501c3 that focuses on the charitable. Let's say a 501c4 that might do some lobbying. Maybe they have a PAC that does the political. And so, and they're all separately, well, maybe not the PAC, but they're typically separately incorporated so that the activity does not get attributed to the 501c3. That's not allowed to do it. Okay, next slide. Okay, with lobbying, how do you know if you're doing too much? There are two ways to do this. You can go with sort of general law, which is a little bit vague. It's no substantial part is the language in the code. And what is it? It's not very clear. If you can research it for a week, 24/7, and you will not come up with anything really very specific. Some say 45%. There's no real percentage. It's all facts and circumstances. The measurement can be time. You can look at time. You can look at money spent. And excuse me, I have a leaf blower right outside my window, which is kind of distracting a little bit. The limitation is also one of the things that need to be in the organizational documents. Remember the organizational test, but that you've already done that, I hope. Substantial lobbying can result in revocation. If you can seriously do some lobbying, 501H election might be the way to go. It's more objective. It's specific dollar limits. It's a math test. So that's absolutely much more definite. So you'd have to kind of look at what you're going to do, how much you can do, how much you're going to spend. Now, in terms of the substantial part test, if you're using volunteers for the lobbying, that counts. However, in the Section 501H test, it doesn't count because it's not an expenditure. Okay. And of course, there's a tax on the excess expenditures for lobbying. And note way on the bottom with this 501H, you can also get revocated if lobbying expenses for over 4 years are more than 150% of the computed math test amounts of non-taxable amount. Okay, next slide. Now getting on to unrelated business income. Again, you can only do this to a limited extent. And the purpose of this was to prevent unfair competition. It started with, I can't remember the charity, but they started a macaroni factory. And it's a very famous case, Miller Macaroni. And this kind of came out of that because they were unfairly competing with other macaroni companies. So basically, you can do this to some extent. And a lot of organizations are kind of afraid to touch this. And I wouldn't be afraid to touch unrelated business income because it can be a good revenue maker, particularly if, grants or other fundraising and contributions are hard to come by. This can be good, and there are ways around it because there are so many exceptions as well. But it cannot be a significant part of the activities. If you remember the operational test, the primary purpose has to be exemption. Again, primary purpose, there's no specific percentage. You can lose the tax exemption if the unrelated business activity becomes significant enough to be considered a primary activity. You can also, if it's not kind of commensurate with what the organization's doing, it's out of proportion to what to the organization's activities, then you could lose the exemption. Now, this if you engage in an insignificant part, you still need to pay unrelated business income tax. That's taxed at the corporate rates, the deductions just like for corporations, and it's reported on a Form 990T. Next slide. Okay. Unrelated business income to one organization may not be unrelated business income to all. So, for example, if a hospital decides to, maybe a small hospital, decides to raise some funds by fixing cars, that's going to be an unrelated business activity. If a vocational school decides to make some money fixing cars, well, it could be part of their activity and not unrelated at all. So you need to check the exempt purposes in the original application. They can be expanded through filing with the 990, but I would start there. See what you told the IRS you were going to do. Now, the key here, and also a common misconception, is the focus is on how the money is earned, not how it's used. I mean, organizations, when I talk to them about some activity, well, how does that further your purpose? Oh, well, it gives us the monies that we use for this, that, and the other thing. That's not the answer. How does the activity further your purpose? Not how the money you make from it furthers your purpose. So you have to look at what the activity is that's earning the money to determine if it's an unrelated business or not. Next slide. Okay. There is sort of like, I'm a very linear thinking person, so there's kind of a linear, but there is a linear thought to how you analyze unrelated business income. There are 3 major components of it. It has to be a trade or business. It has to be regularly carried on and unrelated to the exempt purpose. Next slide. Okay. So what is a trade or business? That's an evolving thing as well. But basically, the courts, the IRS, it looks at profit motive. They look at competition with other businesses. They look at whether it's conducted in a commercial manner. And that has been a big one lately, the commerciality. aspect of it. It's been controversial. I'm not sure the IRS is right when they pull that out all the time, but nevertheless, it's in there as something to look at. So, yeah. So, you have to, it's a facts and circumstances basically, but I say the key factors here are profit motive, which is not the same as realizing a profit, and whether it's conducted in a commercial manner. I wouldn't say competition is a big deal now. That's how it started, but it's sort of evolved over the years. Next slide. Regularly carried on. This means that it's the activity is engaged in the same manner as other commercial activities. So let's say, you have your annual dinner, you have your annual auction, you have your annual, I don't know, sale of bake sale, whatever. The annual bake sale is not competing with bakeries. It's not engaged in the same frequency. It's not open every day. So that would be not regularly carried on. And this is a big one. This gets a lot of organizations out of the unrelated business income. But if it's done in the same way, so for example, if you were in the calendar business and you just do that once a year in December, that could be regularly carried on. If Christmas cards, if you just do that, let's say you do some Christmas card selling from October to December, that could be considered regularly carried on. Running a parking lot, weekly, you'd have to look at all the facts and circumstances, but there's so many ways that something could be regularly carried on or not regularly carried on. You'd have to look at kind of a similar activity and how does the commercial world, how often does the commercial world do it? Okay, next slide. Substantially related. Like I said, one related activity to one organization is not necessarily a related activity to the other organization. To be related, it has to contribute importantly to accomplishing the exempt purposes. The size and extent of the activity needs to be considered. There's an example of a grocery store, I think, that was training, some kind of training program. And what they lost their exemption because basically they said the training program was just too small and the grocery store was just too big. I mean, there just wasn't enough there to be a primary purpose. And honestly, I kind of see that quite a bit sometimes, where they're doing something that looks very business-like, but they're training people to do it. And that's kind of a little bit iffy in terms of getting an exemption. It's a facts and circumstances determination. You just have to look at everything. There is no bright line percentage. There's no bright line test. And again, you look at how the money's earned, not how it's used. Okay, next. There are exceptions, lots of exceptions. These three are good ones to remember, because you've got the volunteer exception, where 85% or more of the work is performed by unpaid volunteers. This is known also as the, well, that's the volunteer exception. I'm sorry, I was thinking thrift shop exemption is that third one. So that's, okay, so that gets a lot of organizations out of the unrelated business income if they've got volunteers working. Convenience exception is also good. So for example, you've got the cafeteria inside the museum. If it's inside the museum, it's for the convenience of the people that are enjoying the museum and, for the exempt purpose. If it's by the museum, but it's got a door to the street and anybody can eat there, then you've lost your convenience exception. If you're still selling, let's say, you're in a school dormitory, you're selling, I don't know, toothpaste to students or something for the convenience of the students, something for the convenience of the students. That could be fine too. Selling donated merchandise, that's what I mentioned before, the thrift shop exception. That's where 85% or more of the sale items are donated. So that's the thrift shop exception. So those would not be unrelated business income tax, subject to the unrelated business income tax. Next slide. Okay. And then there's a bunch of exclusions. These are just statutory, agriculture, educational fairs, trade shows, some hospitals providing services to other small hospitals, some bingo games, distribution of low-cost articles in collection with solicitation contributions. That's pretty common. And the IRS has a particular dollar amount of what is a low-cost article. Can't remember what it is exactly right now because it changes every year. I think it's about $12, $13. Selling your mailing list. That's exclusion if there's no additional services provided. So you don't tailor the mailing list for the organization. They just get the raw data. And qualified sponsorships. That's very specific. Sponsorships are a whole nother kind of ball of wax. And the confusing thing is organizations sometimes call so many things sponsorships. Sponsorship can be a contribution. Sponsorships can be unrelated business income. Sponsorships can be like a fee for service. It depends. Or program service. It kind of depends. Qualified sponsorships are very specific. They will be not unrelated business income. Generally speaking, if the sponsors do not get anything of value. And that's kind of it in a nutshell. It's more complicated than that. But when you do have sponsorships, and they're sponsoring, let's say, I don't know, a program or an event, something, you need to talk to your tax professional to see what exactly is that sponsorship, because I get hit with sometimes like 4 or 5 accounts that are labeled sponsorship. And we have to figure out where it goes on the Form 990 and whether any of it's unrelated business income. Next slide. And more exceptions, and then exceptions to the exceptions, but I won't bore you with that. So dividends and interest are not subject to unrelated business income tax. Royalty, not subject to unrelated business income tax. Rental income, generally not subject to unrelated business income tax. However, there's an exception to that, which there's a number of exceptions, but the main one is if it's debt financed, if there's a mortgage on it, then it could be subject to unrelated business income. And there's, again, a math test. If 85% of the property is being used for exempt purposes, then you're home free on that one. So there's exceptions to the exceptions to the exception. So that's kind of a real complicated thing. So if you're going to rent if you're going to rent property, then you really should speak to your tax advisor, make sure that none of it is unrelated business income subject to tax. Gain and loss from sale or exchange of assets, again, exempt from unrelated business income tax, but again, debt financed. So if you're going to sell a debt financed real property, you might be subject to unrelated business income tax on that. There's a specific $1,000 deduction. There's a couple of other exceptions. If interest, rent, royalty are from controlled entities, they may be unrelated business income subject to tax. And that kind of depends on what the controlled entity does. And then the other exception I already explained was debt financed income. Okay, next. Here's the basic filing requirements. It'd be a 990N if your revenue is under $50,000, under or equal to $50,000. I would suggest if you're a growing organization, if you're new and you're starting out, filing 990Ns, that you keep track of your contributor lists and in any event, because you will still need to prove that you're a public charity. The IRS is not requiring you to file that at the moment, but someday you will need to be reporting that on a full 990 or a 990 EZ, and then to go back and get that information at a later time can be onerous. 990 EZ is the next threshold to up to $200,000. And then over $200,000, you file a 990. Also, if assets are over $500,000, you would file a 990, even if your revenue is under 200. And so some organizations must always file a 990 EZ or a 990 and cannot file the N. And one of them is a supporting organization. You see the little footnote there. Okay, next slide. These are the organizations that can't file an N. Private foundations that file the 990-PF. Supporting organizations. Remember I said there were some organizations that were not public charities per se, but they were riding the coattails of the public charities and not treated as a private foundation. Political organizations cannot file the 990N. And then I just threw that in there for your information. They're not C3s. They're just some other types of exempt organizations that cannot file 990Ns. Next slide. Okay. Also, some organizations cannot file the EZ and must file a full 990, such as organizations sponsoring donor advised funds, organizations that have controlled entities and have to have rent or some kind of interest coming up to the parent that they might need to pay unrelated business income tax on. Organizations that operate hospital facilities. Again, we said supporting organizations. And then group returns, which I don't even want to go into. So next. If anybody has questions on groups, you certainly can call me and ask, but no. The IRS is actually not even issuing those anymore. But they're still out there. The important thing about the filings, the 990s, the 990EZ, the 990PF, the 990T, these are open for public inspection. And so often I say that, well, when you're filling out those forms, you need to not just be thinking about the IRS, because anybody can look at it, and it's on the web. You should probably know ProPublica, the IRS website has it, GuideStar, which I think is called Candid now, has them, so anyone can look. And when I'm about to give money to an organization, I pull up their return, and sometimes I haven't given because I didn't like what I saw. Original amended forms, also your form 1023 or 1024, 1023 for C3s is open to public inspection if it was filed on or after July 15th, 1987. So if you're in organizations older than that, don't worry about it. And then your determination letter also is open for public inspection. Okay, next. Okay, and again, who cares? Particularly, I should have put donors in bold because that's the one that always hits me the most. Your board, yeah, sure, they're probably going to look at it before it's filed. Actually, they should look at it before it's filed, or at least a subset of your board of directors, your treasurer, finance committee, or anybody that will understand it. But donors in particular, competitors, CPAs, competitors, Government and your funders, your lenders will ask for it. The media, and they have, and not always with good intent. Employees, I want to make a note on employees that can look for it. Look at your Form 990 at will. Compensation is reported on the Form 990. The compensation of your officers and directors are reported regardless of the amount. Higher paid people, over 100,000 are reported, even if they're not officers. Certain key employees are reported, and their compensation is right there for the entire world to see. The other thing I want to caution you on is when you're filling out the 990, that section must be taken very, very seriously, not just getting the numbers right, but who is on there. Because you really do not want to report someone, you don't want to make a mistake and report someone that doesn't need to be reported. So I'm very careful that when I say highest 5, I want the highest 5 persons that earn 100,000. I have to make sure that I've got the correct highest 5. I've got to make sure that this person that you're saying is a key employee meets the IRS definition of a key employee, because I do not want to report compensation that we don't have to report. Okay, next one. Okay, there's a multitude of other filings that you may need to be aware of. You may need to file the T, like I said, if there's unrelated business income. Even if there's a loss, I suggest filing the T to preserve the net operating loss. There's, of course, payroll, which I'm sure you do already, 1099s, which I'm sure you do already. There, regarding donors, the 8282, where if you dispose of donated property within 3 years. I want to say also with regarding donors, donor acknowledgements are very important for the donor's deduction, but also you got to say thank you. So, and you need to be careful what is said on those donor acknowledgements. So I would suggest you also talk to your tax advisor about the language on that. Charitable solicitations and charitable trusts, states require reporting. I think there's about 40 states now that require charitable solicitations filings if you solicit in their state. To make matters a little bit worse, states have different definitions of what that means, different thresholds. So I would suggest that, if you're not just soliciting in Washington State, and you do need to file in Washington State, and you typically do need to file for charitable solicitations before you solicit any funds. I would suggest you talk to your tax practitioner about whether you should be filing in other states, which states you should be filing at. And there are some firms that do specialize in just that. So, and your tax professional can either do it themselves or advise you of where to go. B&O and sales tax, as I said, there's no blanket exemption in Washington State. And same thing with property tax, no blanket exemption. I think that might be it. Next slide. I have key takeaways. Next slide. Okay. There's no key takeaways.
I think, Karen, from your perspective, working with smaller not-for-profits, what would be like the one thing from a tax side that you'd want to make sure they were doing?
Oh gosh, I can't really think of one thing, but it depends on where they are. I would make sure that because I've seen so many things kind of go haywire. I do a lot of applications for exemptions. So the first things first, make sure that your purpose is a charitable purpose, is one of the exempt purposes, and that's the primary purpose. And then make sure that, I think the key takeaway is talk to your tax practitioner if you're going to engage in anything. That's why I set this up as a can do, can't do kind of thing, more of not to really educate you on everything because it is so complicated. But just enough in there so you know when to ask the questions and what questions to ask.
Yeah.
So I guess that's the key takeaway.
Yeah. And from an audit perspective, you know, knowing when you need to have an audit, whether or not it's a financial statement audit or a single audit, and then making sure documentation is key. So document, document, document. If you don't document something, there's no way to prove that it happened. And from an outside party coming in to look at it, that's what we want to see. I think the rest of the slides, we've got some slides here on just not-for-profit essentials. If you're ever interested, please visit our website. We do webinars all the time. We've got some links to recordings that have already happened in the past if you're ever interested in just getting more information on just not-for-profit essential type items. And I think that's all we've got.
Well, thank you both. That's amazing. I did have one question, that we commonly get for nonprofits that we work with, especially when we're filing 990s or asking, advising on how they may, which 990 form they may want to fill out. And so the question we get, is, are grants revenue? Like, how do you treat grants? And then how do you treat, like, maybe you got a $200,000 award, but you only spent 25,000, do you claim it on your taxes? Because we get, folks being a little creative, like, okay, the 990 is based on how much money you have in the bank at the end of the year, right? I'm like, no, but that nonprofit and grant thing sometimes gets people confused. Can either you, Kelly or Karen, maybe comment on that a little bit for us?
I'm not really sure I'm understanding the question. So
If somebody gets grant funds, if I got a $200,000 grant as a nonprofit, and let's say I spent all the money that year, would I have to file a 990? And which form would I have to file if I do?
you got a $200,000 grant,
Yep,
and you spent it
yep.
on your programs.
Mhm.
That would be a full 990. If you got
Yes.
199,000, that's not 90 easy, but I digress. So why would they think they did not have to file? That's what I'm not understanding.
Oh, yeah, me too. So I think sometimes folks, they tell me, I call the IRS and they say, we're not taxable, so I don't have to fill out anything but like the smallest form, the 50,000. And I'm like, well, but you've got more money in the bank than that. So I think it's just confusing on when you file and how much triggers a filing threshold. And if you're a nonprofit and you get a grant, isn't it just free money, right? So there's all these things that people don't quite understand, and we're like, no.
Yeah.
Yeah, if you could explain it.
Yeah. Okay. So the thresholds, when I don't know if we want to go back to that slide, that little grid there. Okay. That's gross receipts, so it's receipts. That asset test is a completely different thing. So, I mean, it's not completely different. You see the ands and the ors. Okay. So within your example, we're talking gross, sorry, something popped up on my screen. 200,000 in your scenario is you file a full 99 gross receipts. So net doesn't matter. So even though there's some expenses or there's whatever, you're still in a 990 now. Or assets. So let's say you got 150. So you think, oh, I need to file a 990Z. But you have, from prior years, you've got 600,000 of assets. You have to file a full 990. So it's kind of a two-part test. The only one that does not have both a gross receipts and asset test is the 990N. And you're only looking at the tax year. And not only are you only looking at the tax year, but you're using your method of accounting, whatever you have chosen. If you're cash basis, you're looking at your cash basis. If you're accrual basis, that's the gross receipts you're looking at.
Okay, that helps me, thank you. And the other question we had as people were signing up is, like, how would you document in-kind donations?
Okay, I have a tax answer for that, but I think Kelly should have, might have an accounting aspect. So I'm dealing with one just right now. Basically, from a tax point of view, the in-kind, depending on what you're talking about an in-kind physical object, somebody gives you a car, you book it at its fair market value when it comes in. When you get services, now here's where Kelly and I are going to differ, because for tax purposes, the in-kind donated service is not counted anywhere. So when we get your financials, because for GAAP, it would include it, we always back it out for tax purposes. The other thing that I want to say for auctions, commonly done incorrectly, when those auction items come in, that is booked as an in-kind contribution. Later, when you sell it, you get your special events revenue from selling it. If that makes any sense.
Yeah, and from a GAAP perspective, there are only certain areas that you can count as in-kind, so volunteer services don't qualify to be booked as in-kind. I have a lot of organizations that disclose how much they have in volunteer services because it's useful to the users, but it's not a number that then shows up on their financials. Again, for even services, it has to be something that somebody has the expertise to do that you would be paying for otherwise, like legal services. It's not just a volunteer doing something. It has to be a skill that they're donating essentially to you that you would be paying for otherwise. And again, you're booking it at fair market value. The donor may tell you what the fair market value is, but you as the organization have to do your own assessment of what the value is. And in your thank you letters to the donor, you really should not disclose the value. You should instead say thank you for this donation, because the donor may value it differently on their tax return than you necessarily are valuing it, because you're determining what that fair market value is.
And if I could add something to that, never put the value on the donor acknowledgement.
Yeah. So you just say, thank you for donating a bottle of wine to our
Yes, exactly.
gala. So that's one of the key things that is important, because we have had clients where they have gotten a donation that they say the donor values it at this, can we just use that? And if management has determined it's reasonable, that's fine, but you need to kind of do your own assessment too for that value. Great questions.
Yeah, that's a great point. Thank you for that. I didn't realize that. I know we're just a few minutes over time. Any other questions from our group today? Everybody's in awe.
Well, thank you for having them.
Or we bored them to sleep.
I know it's a lot of information, so if there's any questions, I think you mentioned the slide deck was going to go out. We've got our contact information as well if you have any follow-up questions. So
no, thanks very much. And I'm sure they'll let it marinate and have a follow-up with you on their own. But thank you everyone for attending today. And this is a super important topic, and thanks for being ahead of the game and just entertaining us with all this wonderful knowledge. Thanks Karen and Kelly, you are amazing at this. I love that you think this is all easy. And I'm glad you shared your knowledge with us.